All right, folks. So here we are in the fundamental analysis side of this sort of mini lecture series. Um, I like to think of fundamental analysis as comprising two parts, right? But it's all kind of in a cohesive effort of study. Um, I see there's the economic side, so it's a top down approach. Like there's the big economy, and within it, there are companies. And then I also see the company analysis. So, right down to each individual company that you may invest in, right? So, all of these companies, that's if you looked at it from the company side, it would be like bottom up. There's a bunch of different companies comprising a larger section of the economy. And then if you think about it from the top down, there's a giant economy, and within it, there are a bunch of companies. So in this lecture, we're going to talk about the economy side of things and different indicators or areas of study that we might look into when we're looking at the greater economy so that we um, invest with better knowledge, right? So I start with the economic environment. So when we start looking at the market, we have to look at the economic environment in which the stock market exists, right? We have a currency market, like the foreign exchange market, Forex. There's cryptocurrency. There's a labor market. There are futures markets, commodities markets. And so, but they all exist under this economic environment, this economy, right? And then there's a national economy, and then there's an international economy, right? So if our company is a solid choice, but there are problems with the overall economy, we may see the stock underperforming relative to a healthy economic situation, right? So if we were in a better economic situation, maybe our company would perform better, right? So we have to keep it in mind that if we here's a good way to look at it. If the economy was like the ocean or waves, big waves in the ocean, and each company or stock is the boat. When the wave goes up, the boat goes up with it. And when the waves go down, the stock goes down or the boat goes down with it. And so when the economy is doing well, generally stocks tend to do well. When the economy is suffering, stocks tend to suffer, right? So, and that's a generalization, but you get the idea. So, where do I read about economic news? Where do people that I trade with read about economic news? Well, you can go to the Wall Street Journal. They have Yahoo Finance. They have MarketWatch. They have Trading Economics, Benzinga. Take a look at what major trends are occurring in economic news, and it'll help you fine tune your vision for the outlook of the economy. So, find the most impactful stories. Maybe the economy is going through issues with inflation. Maybe the economy has high unemployment. Maybe there's a countrywide or global health epidemic or crisis. Maybe there's a political conflict. Countries, fighting over, whatever it is. Um, the news will help you determine what's affecting markets, but it's where you get your news as well, right? The consideration is where you get your news when we start looking at economic environment. We don't want to just get, willy nilly news, popular magazines, or even just MSN.com sometimes just has general news. We don't want to just go to CNN or Fox, the easy ones. We're looking for economic news. So we go to economic news sources. Um, and like what a celebrity wore at a Met Gala or at a different event, that probably won't affect the stock market as much. It may, but probably not. Or what a celebrity thinks about a stock. We don't really pay attention to that, at least the people I trade with. It may, but chances are slim. Filter your news out is the main message I'm trying to communicate here, right? So the biggest economic indicators I use in fundamental analysis, I check four major economic indicators, and there are some others that I'm learning as I go, but these are the big ones for me. In no particular order, consumer price index and PPI to go with that, producer price index, interest rates, also in America, we call it the federal funds rate, um, unemployment levels, and GDP or gross domestic product, So I'm going to go over each one of these. So CPI and PPI. I'm going to start with the stuff that most people probably are challenged to learn about, or they don't have knowledge of. So CPI is called the Consumer Price Index, or it's also known as, and PPI is the Producer Price Index when we're talking about economics. So CPI is a measure of a basket of consumer goods um, compared to a reference year. So they take, maybe cars, groceries, different things you may buy as a consumer, a retail consumer, a given year, to survive and thrive in your life, and they set a price on it, and they'll create a basis. So maybe in 1990, they'll create a basis CPI, and each year, 91, 92, 93, 94, 95, the CPI will be based on that reference year. And they'll keep creating this basis because the basket of goods changes as people, as our society evolves, as technological progress moves forward. Um, Back in the 90s, for example, which is the example I used, people didn't really have laptops and smart tablets, smartphones. They didn't really even have cell phones available to the masses. And so, but back then, maybe desktop computers were really popular, or people used Rolodexes and different technologies, right? So instead of having all your contacts in a phone like we have in the 21st century, people have, they would have a Rolodex where you would keep professional business contacts and personal business contacts. So the basket of goods changes, and maybe people back in the day ate more, processed foods. Nowadays, people are moving toward the organic side of things. So the basket of goods is in flux. And so it's difficult to calculate this number exactly, but it gives us a reference value for like how much things typically cost on an everyday basis, right? And PPI is the Producer Price Index, basket of goods for what it takes, what things they need to buy to support that company, that firm, keep it in operation, keeping it profitable. So businesses have they have a select number of things they need to buy to stay afloat. And so there's a PPI number for Producer Price Index. What do manufacturers have to pay to stay going? And there's a number of things they have to buy, right? So these both numbers, the important thing to know here is both of these are a thermometer for inflation. And so both measure the price changes in a range of goods and services. So high prices discourage consumer spending, which makes up more than 2/3 of GDP, or it's thought, right? So if the CPI and PPI are high, it could be an indication that inflation's running hot, and the Federal Reserve or the respective country's central bank, government bank, is likely to want to raise interest rates to control inflation, right? They make money more expensive to borrow, and therefore people spend less, and it controls the price of the goods, because if there's a high demand, prices will increase. So they want to level all that out, this consumer spending and even business spending through PPI. So how do CPI and PPI affect the market? High reported CPI or PPI tends to be bearish for the market. It tends to make the market go down. And a low reported CPI or PPI is bullish. It tends to make the market go up. Okay. So federal funds rate, or the main interest rate, right? This is another one that people might not know when they start investing. So the federal funds rate is basically the main interest rate that banks charge each other to borrow or lend excess reserves overnight. Banks like to borrow money. Institutional investors like to borrow money. Big spenders borrow money. Even individuals, when they buy a house or they buy a car, they may borrow money through a loan. And that loan has an interest rate. There's a premium you pay to borrow that money at a given rate. Maybe it's a monthly interest rate, a yearly interest rate. You're paying some interest rate. The government's interest rate influences all of these. Why does this affect stocks? Interest rates increase the cost of borrowing money, and therefore makes investors more hesitant to spend money on things, including stocks. It tends to be paired with the Federal Reserve raising bond yields, which is a security that competes with stocks. Basically, bonds are the government borrowing money from whoever's invested in them, and then they will pay that money back with an interest on it, right? You buy $1,000 bond, So you're paying for a bond, but you're loaning money, and it's paid back in with interest, right? So how does this interest rate and borrowing money thing affect stocks? Well, when there's high interest rates and money's expensive to borrow, banks have to borrow. They like to borrow money to invest. So, or institutional traders will borrow money to invest. High interest rates is bearish for the market. It makes the market go down. Low interest rates is bullish. It makes the market go up, right? All right, unemployment. This may be something that people are more familiar with, but there are very disciplined metrics and ways of calculating unemployment. Here's what you got to know for stocks beginning. Literally, this is just the number of unemployed people in an economy divided by the population of the economy. There are more nuanced metrics. There are more specific metrics. This is the one we want to know. Why it affects stocks? It's complex and a somewhat paradoxical effect, but a large number of analysts believe that higher unemployment levels promote a bullish market. Okay. This is weird because you'd think that high unemployment is bad, and it varies. It depends on the situation. But here are two reasons why high unemployment might be good for a stock market. One, unemployment is typically the lowest when an economy is strong. So if it's low unemployment, a strong economy might be a sign of what? High inflation. There's a lot of people spending money, so the price of things goes up. Central banks adopt a hawkish policy or a more strict policy on money to cool the economy. So by having all these people spending money and burning through it and prices going up, the government raises interest rates, and that makes the stock market go down. So sometimes low unemployment will make the stock market go down. Everybody got a job, but because of this inflation thing burning up and getting hotter and hotter, it can actually adversely affect the stock market. The second reason is when unemployment is low, market valuations are generally already at high levels. So future returns become modest at best, right? So a lot of stuff will get priced in. And there's an increased likelihood of downturns and corrections because, okay, unemployment is low, everyone's got a job, GDP is going up, money's being spent, passing through the economy like hotcakes. But market has already priced that in. And so it could actually cause a downturn in the market. So unemployment rate is a little bit tricky. But high reported unemployment, from my experience, I found can be bullish for the economy, and low reported unemployment can be bearish. But it depends. There are cases where high unemployment is bearish for the market and low unemployment is bullish for the market. It's good for the economy. So if inflation's under control, but not everyone has a job, still people aren't really spending a lot of money, that could be bad for the stock market. Okay. And then lastly, GDP. So of these four things that I would like to cover today, GDP, gross domestic product. What is it? It's the total of all value added or created in an economy, meaning the value of goods and services that have been produced minus the value of goods and services needed to produce them. How does this affect the stock market? Goods. So it's goods and services being made, right? And you can divide it by the number of people in that economy to get the GDP per capita, per person. Generally, if corporate earnings are low, GDP will be low, right? Companies aren't making a lot of money. They're probably not producing a lot. Stocks will seem overvalued and the price will go down. And if corporate earnings are high and GDP is high, stocks will seem more undervalued, right? Maybe a company is having increases in reported earnings period over period, quarter over quarter. That may make the stock go up. And if that happens with several companies in a larger economy, companies are becoming more efficient, working better, faster, whatever it is, technological progress, GDP is going up, stocks will tend to go up as well. So other economic factors can give this less of an effect, and all of these, they work interrelatedly, and that's it. They work kind of symbiotically, right? So GDP and interest rates and unemployment and interest rates, inflation, these things all work kind of, and CPI and PPI, they all kind of affect each other, right? But and if one has a very strong effect, each one can have a very strong effect on the market individually as well. So, but generally, GDP, high reported GDP is bullish for a market. Low reported GDP is bearish for a market. Okay. So you got to balance what's going on when you're studying this stuff. Consider how each of these affects the market, and maybe I would write a short summary, a couple sentences, maybe more, a paragraph about how each of these economic indicators might affect the market. Read what these economic news sites are saying about these topics in the country you're investing and the world at large. See if you can draw connections to market index prices. So check your indices, right? If you want to look at some ETFs, exchange traded funds, they're kind of like mutual funds with differences, but basically they're groups of stocks that are traded as a single stock. I'll simplify it that way. They have a VTI, that's the ticker for the total market index for Vanguard study. It's a ETF that Vanguard runs. The SPY, the S&P 500 index ETF. The QQQ is for the NASDAQ ETF, the NASDAQ index ETF, and the VIX, the volatility index, is something to check. And the UVXY is a short-term volatility leveraged ETF. I wouldn't trade that if you're not experienced, but look at these and see how they're responding to different economic events, right? So the total market may be going down. You say the VTI going down, the S&P, which is the collection of the largest companies in the American stock market. The QQQ is for like technology and science. You'll see that moving up and down as the economic situation changes. And the volatility index, it generally, if I could say, it influences it's an indicator of the price of options or money derivatives. And so when people are buying money derivatives, they're basically instruments to invest with. If there's fluctuations in price and volume of these money derivatives, it can affect the market, right? So look at all of these, balance what's going on. Look on the charts and see if price action makes sense with the economy. If the economy is in rough situations, you'll see hundreds of stocks are being affected, if not thousands, right? Maybe it's just something that's affecting the American economy and foreign stocks are not being affected. Look at that. There's a VEU ETF, which excludes America. It's international stocks, right? So, and then you can look at specific international stocks. There's stuff like Alibaba and Tencent is from China. There's a Mercado Libre is a South American stock. They have different stocks around the world, but see if most stocks are going down or if an entire index is going down, there's something going on in the economy. Similarly, if it's rebounding or entire groups of stocks are rebounding, maybe a particular sector is rebounding, maybe a sector is affected by the economy, check and see what's going on in the economy, and it will make sense why there are big moves in the market. Remember, it's like waves. So look on the chart and see if price action makes sense. If not, do more research as to why you think experts think the price is moving the way it is. Find the info you're missing. If you're going on these news sites and various experts are agreeing with with a certain thing going on, look at your own analysis, right? When you have groups of people coming together and coming to similar conclusions, it can kind of point you in a direction of what might be going on. But it's your job to do your due diligence and study this stuff well, right? But, you get better and better as you practice more. So here's an example, the dot-com bubble. So this is, 1999, 2000, 2001. There was, all this money being pushed into all these theoretical or new computer companies or tech companies, software companies. And there are so many companies and only a few of them end up getting the money and a lot of them just became obsolete. So a lot of money got pumped into the economy or into the stock market. A lot of money left the stock market. You can see it on a chart, but if you don't understand economics, you'll miss why this big swing in the market is happening. The 2008 financial crisis had to do with the housing market crash and people getting sold these, subprime mortgages, not having collateral to buy houses with, just They're just selling houses, making agreements and deeds, and selling these houses like 40 going north. And when people defaulted on their house payments, what was the collateral to back it up? The market implodes, and a lot of these banks are selling these money derivatives, trying to make sense of the market and get some profit, stay afloat. Um, and they're coming up with all these like synthetic derivatives and things to manage this situation. And what ends up happening is a lot of money is wasted, lost, um, a lot of fallout economically. If you don't understand what's going on, or if you don't not even paying attention to the economic news, you're not going to understand why the market is tanking like this. You can see the market lost a significant amount of value in just a few days, weeks. And then, kind of funny, on the same chart here, so this is a monthly chart, I believe, you can see the flash crash of May 6, 2010, just a couple years afterward. They had a flash crash, another economic event. If you missed it, it's like, okay, well, whatever. But you can see the market tanked like crazy in just, a very, very short period of time, right? I think it was a particular day, May 6th. So again, if you're not paying attention to the economy, what's going on, you might miss why these big swings in the market are happening. You might be like, why is my stock failing? It's a great company, and it's the economy. And then the 2020 pandemic. Again, stock market's doing pretty well, moving along, moving along. A giant pandemic hits, a viral pandemic, and the market tanks because people are scared. They're like, well, should we go outside? Is the government going to regulate, going outside, which they did? Are we going to have to wear protective gear? Can we eat, food collectively in public? A lot of different things. And again, if you're not paying attention to the economics, if you're not paying attention to global economics, socioeconomics, all this stuff, what's happening in the world, and you're just looking at your stocks, you're not going to understand, why is the market collapsing? Why are all my stocks collapsing? Why am I losing money? Kind of thing. But you get the idea. Big economic events can have significant effects on the market, which I just stated. It's the next title. So economics can have serious effects on the market. And so it's worth first looking at the economic environment in which you're invested, being able to gauge the health, so to speak, of that market's economy on a micro and macro level, and go from there. This is also why it's a good idea to hedge positions. And when we talk about specifics of a trading plan, you'll learn how to reduce your exposure to risk, because there are things called black swan events, which is unexpected events happening in the market, and it totally throws the market off. But if you hedge your positions, you're protected from a lot of risk that you would face if you just have, naked positions, or if you're just going long on everything, or, looking to buy and it's a seller's market. So pay attention to your economics. This is just a video to help, you put some things together. Go back, do some homework, do your studies, and stay with it, guys. In the next video, we're going to be talking about the fundamentals of a company. So the actual companies that you'll be invested in. So thank you guys for tuning in, and I'll see you in the next video.